Now in this section, we're going to be looking at how bonds are priced. Determining the price of a bond issue. So assume on January 1st, 2018 that California Coasters decides to raise money for development of its new roller coaster by issuing $100,000 of bonds paying a stated interest rate of 7%. The bonds are due in 10 years with interest payable semi-annually on June 30th and December 31st of each year. In practice, most corporate bonds pay interest semi-annually every 6 months rather than paying interest monthly, quarterly, or annually. So investors in California Coasters bonds will receive the face amount of $100,000 at the end of 10 years and interest payments of $3,500, which are going to equal $100,000 times 7% times 1/2 a year every 6 months for 10 years. That's a total of 20 interest payments of $3,500 each, or $70,000, or $70,000. This slide provides a timeline of the cash flows related to the bond issue. Now, over the 10-year period, bondholders will receive a total of $170,000, which is the face amount of $100,000 due at maturity plus semi-annual interest totaling $70,000. How much are investors willing to pay today for the right to receive $170,000 over the next 10 years? Certainly less than $170,000 because the cash flows are in the future. Next, we'll see how to determine the price. The stated interest rate is the rate quoted in the bond contract used to calculate the cash payments for interest. The market interest rate, also known as effective interest rate or yield rate, represents the true interest rate used by investors to value the bond issue. The market rate can be equal to, less than, or greater than the stated 7% interest rate paid to investors. In this slide, we assume the market interest rate is 7%. The same as the stated interest rate. Later, we'll calculate the bond issue price when the market interest rate is less than or greater than the stated interest rate. Now, the number of periods to maturity is the number of years to maturity multiplied by the number of interest payments per year. Since the bonds pay interest semi-annually, twice per year for 10 years, there are 20 periods to maturity. This slide demonstrates how to use Excel to determine the issue price. So we would put in the present value of the face amount times the number of periods, the interest payment, and the market interest rate to come up with the issue price. This slide calculates the price of the bonds using the present value tables provided at the back of the textbook using the same assumptions. So again, we'd look at the present value tables and we would use the present value of the face amount. We would take that on for table 2, and then the present value of the interest payments, we would use table 4 for that, since that is an annuity. And we would use the factor for the annuity. In this slide, we assume that California Coasters issues the same $100,000 bond, a 7% bonds, when other bonds of similar risk and maturity are paying a market rate of 8%. Now, California Coasters bonds aren't as attractive to investors because investors can purchase bonds of similar risk that are paying a whole point of interest higher. So because of this, to make the bonds more attractive, California Coasters will have to issue its 7% bonds below its $100,000 face amount. So bonds issued below the face amount, like this, would be said to be issued at a discount. So in this illustration, we have to recalculate the issue price of the bonds, assuming the market rate of interest is now 8% per year or 4% each semi-annual period. Now this slide shows how to use Excel to determine the issue price. Again, the formula to compute the issue price is shown on the formula bar. So we would use the present value table, and we would show the market interest rate per period, the number of periods, the interest payment, and the face amount to come up with the issue price of $93,205. This slide shows how to calculate the price of the bonds using the present value tables provided at the back of the book, assuming the market rate of 8% per year, or remember, we calculate it by number of periods, the interest rate per period, so we would use 4% for a semi-annual period. So again, we would go to Table 2 for the principal amount, because that's paid a single payment, and that's for a single payment present value, the Table 2. And then Table 4, we would use the annuity present value table, because those interest payments are received over the life of the bond. So that is an annuity payment over a period of time. Again, in each, we're going to take the interest rate of 4 and the number of periods, 20. It's 10 years, but they're being paid out twice a year. Now, a key thing to remember here is the interest rate we use to calculate the bond issue is always the market rate. It's never the stated rate. The stated rate only shows what's on the face of the bonds. Some people get that confused and incorrectly use the stated rate to calculate the present value. The stated rate to calculate the interest payment each period is how we calculate interest, but we use the market rate to calculate the present value of cash flows. Really key to remember that when you're working on problems here. Now, in this slide, we're going to assume that California Coasters issues 100,000 of the 7% bonds when other bonds of similar risk and maturity are paying a market rate of only 6%. So the stated rate is 7, the market is 6. In this case, investors are going to pay more than 100,000 for these 7% bonds, since they look pretty attractive compared to bonds that are just paying 6%. So in this scenario, we say these bonds are being issued, sold at a premium. A premium occurs when the issue price of the bond is above its face amount. In this slide, we recalculate the issue price using the market rate of 6% or 3% annually. So the issue price of these bonds would be $107,439 to purchase these bonds. Now, this slide shows how to use Excel in determining the issue price. And this slide calculates the price of the bonds using the present value tables in the back of the book. Again, same concepts. The principal amount is you're going to use a single value, single payment. And in the interest portion, you're going to use the annuity tables for the present value. If the bond's stated interest rate is less than the market interest rate, then the bonds will issue below face amount, which would be a discount. If the bond stated interest rate equals the market interest rate, then the bonds will issue at face amount. And then finally, if the bond's stated interest rate is more than the market interest rate, the bonds will issue above face amount, which is at a premium. Most bonds initially are issued at a slight discount. Because there's a delay between when the company determines the characteristics of the bonds and when the bonds actually get issued, the company has to estimate the market rate of the interest. Bond issuers usually adopt a stated interest rate that's pretty close to, but maybe a little under, the expected market interest rate. But in future periods, bonds may either trade at a discount or a premium, just depending on what changes have happened with the market rates. So remember here, guys, that the issue price of the bond is equal to the present value of the face amount, which is the principal, payable at maturity, plus the present value of all the interest payments. And those are periodic interest payments because they're done over semi-annually. Bonds can be issued at face amount, below face amount, or above the face amount. Let's look at a question here. If a 10-year bond is issued with a stated rate of 9% when the market rate is 8%, the bonds will be issued at, what do you think? Premium, discount, face amount? Can't determine it. Remember, premium. When the stated rate is higher than the market rate, then we have to issue the bonds at a premium, because in order to meet up with the market rate, we've got to sell those bonds for a bit more money. Let's look at exercise 9.6. On January 1st, 2018, Waterworld issues 26 million of 7% bonds due in 10 years, with interest payable semi-annually on June 30th and December 31st each year. Waterworld intends to use the funds to build the world's largest water avalanche, and the tornado, a giant outdoor vortex in which riders spin in progressively small and faster circles until they drop through a small tunnel at the bottom. If the market rate is 6%, will the bonds issue at face amount, a discount, or a premium? And we're supposed to calculate the issue price. So again, remember that if the stated value is greater than the market rate, those bonds are going to be issued at a premium. So the way we calculate the bonds is the 26 million bonds would be the face amount. The interest payment is 6%, so that would be 3% per period, and there will be 20 periods. So in order to calculate that present value issue price, we would have, the output would show 27,934,072. I'm going to try to do this so you can see how this works through the Excel. So I'm going to show you an example of how this works through Excel. We're going to use financial equation for present value. Now it asks us for the rate. The interest rate is 3%. The number of periods, remember it's 10 years semi-annually, so it's 20 periods. The payment is $910,000 is the interest payment. The future value that we're going to be getting is the $26 million, the bond. And so in doing that, it will show that the present value issue price will be $27,934,072. So again, it's using the financial calculator and or the financial formula, present value, and you'll just want to input the necessary information in the applicable areas. Okie doke. So let's look on this one, this next one here, that shows that if the stated rate is 7% on the bonds and the market rate is 7%, will the bonds issue at face amount, a discount, or a premium? Well, they're going to issue at face amount, but let's just go back again with Excel and put in the information, okay? So we're going to go into the formula for present value. The interest rate is going to be 3.5%, 3.5%. Number of periods 20. The payment is $910,000, which again the payment is derived from the interest rate on the bonds. The future value is going to be $26 million. And as you see, look, the rate we would show, the issue price would be $26 million. Okie doke. Now, in this scenario, the market rate is going to be 10% and the stated rate on the bonds is 7%. We know it's going to be issued at a discount because the market rate is greater than what the stated rate is. Again, if you look at your information, we've got the face amount, the interest payments, the market rate, and the number of periods to maturity. I'll do that one more time for you to show the present value. The rate is going to be 4%, which is per period, 20 periods. The payment is $910,000. The future value is $26 million, and in doing so, it would give us the issue price to be $24,233,258. Next, we're going to look at recording the issuance of bonds and the related interest. Accounting for the issuance of bonds. So to see how to record the issuance of bonds and the related interest, let's go back to our initial example. On January 1st, 2018, California Coasters issues 100,000 of 7% bonds due in 10 years, and it has interest payable semi-annually on June 30th and December 31st of each year. On January 1st of 2018, the bonds issue for exactly $100,000 and assuming a 7% market interest rate. California Coasters records the bond issue as shown in that first journal entry, cash of $100,000, bonds payable of $100,000. California Coasters reports bonds payable in the long-term liability section of the balance sheet. 9 years from now, when the bonds are within 1 year of maturity, the firm will reclassify the bonds as current liability. Now, on June 30th, California Coasters records the first semi-annual interest payment, as we see on this second journal entry. The company will record this same semi-annual interest payment at the end of every 6-month period for the next 10 years. When bonds issue at less than face value, we say they issue at a discount. On January 1st, the bonds are issued when the stated interest rate is 7% and the market rate of interest is 8%. The bonds will sell at a discount and will be issued at only $93,205. This is less than the $100,000 face amount because the bonds are only paying 7% interest, while investors can purchase bonds of similar risk by paying 8%. The difference between these two amounts is debited to discount on bonds payable. The difference between the bonds payable account and the discount on bonds payable is called the carrying value. The carrying value will increase from the amount originally borrowed of $93,205 to the amount due at maturity, $100,000, over that 10-year life of the bonds. We calculate each period's interest as the carrying value, which is the amount actually owed during the period, times the market rate, the 4% semi-annually or the 8% annually, in our example. This method of calculating interest is referred to as the effective interest rate. For the first interest payment, interest expense is the carrying value of the bonds times the market interest rate per period, which is the 37.28. Then we have to also amortize the discount on bonds payable, which is going to be the difference between what our interest rate is and the cash that is being paid out. Now, the cash being paid out is the $100,000 times the stated interest rate on the bonds, 7% times half a year. So the $3,500 is what we're going to be paying out based on the bonds, but the interest expense is going to be the market rate. So the carrying value, the initial issue value, times the market rate, times the 6 months, or 4% per period. Now, on the next payment, the two entries represent here these first two cash payments. As you see here, the amounts for the semi-annual interest payments are taken directly from the amortization schedule that we're going to see on the next slide. So this bond amortization schedule is going to summarize the cash paid, the interest expense, and changes in carrying value for each semi-annual interest period. This slide provides an amortization schedule for the bonds that are issued at a discount. Note that the amounts for the June 30th, 2018 and the December 31st, 2018 semi-annual interest payments shown in the previous slide can be taken directly from this amortization schedule, as you see right here. Sometimes students incorrectly record interest expense using the stated rate rather than the market rate. Remember, interest expense is the carrying value times the market rate, while cash paid for interest is the face amount times the stated rate. Now let's assume California Coasters issues $100,000 of 7% bonds when other bonds of similar risk are paying a market rate of only 6%. The bonds will issue at $107,439. Investors will pay more than $100,000 for these 7% bonds because bonds of similar risk are only paying 6%. When bonds issue at more than face value, we say they issue at a premium. So California Coasters records the bond issue as shown right here in this journal entry. We're going to show cash of $107,439, bonds payable of the $100,000, and the premium on bonds payable, which is the difference, of $7,439. Now the balance of premium on bonds payable gets added to bonds payable in the balance sheet as shown on the slide here. Initially the carrying value is $107,439. California Coasters will need to pay back only $100,000 when the bonds mature in 10 years. But the carrying value will decrease from the $107,439 issue price to the $100,000 face amount over the 10-year life of the bonds. So we calculate interest expense as the carrying value times the market rate, which again, the carrying value is the $107,439 times the market rate of 6% annually or the 3% semi-annually. On June 30th, 2018, California Coasters records an interest payment, assuming the bonds were issued at a premium, as shown in the next journal entry. Now, when bonds are issued at a premium, the carrying value of the debt decreases over time. That's why we debit premium on bonds payable, because the premium's decreasing over time. Since the carrying value of the debt decreases over time, interest expense will also decrease each semi-annual interest period. California Coasters records interest for the next semi-annual interest period on December 31st, 2018, as shown here on the journal entry below. The interest expense is the $107,439 minus the $277 times 6% for half the year, or 3%. Then we will show our cash, which is going to be the information listed on the bonds. and the difference is going to be the premiums on the bonds payable. Now this slide provides here an amortization schedule for the bonds issued at a premium. Note that with a bond premium, the difference between cash paid and interest expense decreases the carrying value each period from $107,439 at bond issue down to $100,000, the face amount, at bond maturity. This slide shows how carrying value changes as a bond approaches its maturity date. Remember, when bonds issue at face amount, the carrying value and the corresponding interest expense remain constant over time. When bonds issue at a discount, which is below face amount, the carrying value and the corresponding interest rate increase over time. And when bonds issue at a premium, which is above face amount, the carrying value and the corresponding interest expense decrease over time.